Good morning. Welcome to the class of BBA 5th semester 31st session of Advanced Financial Management. Today I am going to discuss about approach of capital structure theories. Last class we discussed about traditional approach of capital structure theories and also we calculated the problems based on the traditional approach. The session objective of this chapter is to provide an understanding of the cost of capital and capital structure in decision making process. The session outcome is, as a student, you will be able to understand theory of capital structure and what are the assumptions, what are the propositions, what are the drawbacks of this approach and conditions. Here we are going to see. This approach at first was defined by Modigliani and Miller. These two authors, economists, during the 1950s. It is similar to of the net operating income approach. This theory says that the valuation of a firm is irrelevant to the capital structure of the company or firm. And also it says that the market value of a firm is affected by its operating income. The assumptions are important. The assumptions are of theory are as follows. First assumption is there are no taxes. Next one is transaction cost for buying and selling securities as well as the bankruptcy cost is nil. That means there is no transaction cost while buying and selling of securities. Third assumption, there is symmetry of information. This means that an investor will have access to the same information that a corporation would, and investors will thus behave rationally. Means all investors are well known about the information of the market regarding the securities. Next assumption, the cost of borrowing is the same for investors and companies. The borrowing cost is the same. Next assumption, there is no flotation cost such as an underwriting commission, payment to merchant bankers, advertisement expenses, etc. That means the cost of the issue of equity shares is nil. Next assumption, there is no corporate dividend tax. The tax rate is for dividend and capital gains are different, but here there is no corporate dividend tax. This is the assumption. Next, in the proposition 1, the approach says there is no taxes. The capital structure does not influence the valuation of a firm. It means the leveraging the company does not increase the market value of the company. It also suggests that debt holders in the company and equity shareholders have the same priority. That means earnings are split equally amongst them. Here the value of the firm is market value of equity plus market value of debt equal to expected EBIT or expected net operating income by expected overall cost of capital rate Next, MM's proposition 1 is that for firms in the same risk class, the market value is independent of the debt equity mix and is given by capitalizing the expected net operating income by the capitalization rate appropriate to risk class. Hence, the formula for proposition 1, value of the levered firm equal to value of unlevered firm. Value of firm equal to net operating income by firm's cost of capital. It is as usual we calculate in traditional approach. Investment in any kind of firm gives the same result, and what matters is the earnings generated. Next, coming to proposition 2. In the proposition 2, the authors said the financial leverage is in direct proportion to the cost of equity with an increase in the debt component. The equity shareholders perceive a higher risk to the company. Hence, in return, the shareholders expect a higher return, thereby increasing the cost of equity. A key distinction here is proposition 2 assumes that the debt shareholders have the upper hand as far as the claim on earnings is concerned. Thus, the cost of debt reduces. Here, the debt equity ratio equal to the overall cost of capital equal to RA plus RA minus D into the RA is refers overall cost of capital in multiplied with debt equity ratio. The proof of proposition 2 shows that because interest payments are tax deductible, the value of a levered firm increases with the debt. The value of levered firm equal to value of equity plus tax into interest rate, that tax shield, whatever the deduction on the deduction of the tax on interest. Here B is the value of an all equity firm, TC is the corporate tax rate, and D represents in the interest tax shield. Coming to proposition 3. It says that the cutoff point of investment is always the capitalization rate, which is completely independent and unaffected by the securities that are invested. Cost of capital of levered firm is equal to the cost of capital of unlevered firm. The overall cost of capital of levered firm equal to overall cost of capital of unlevered firm. Cost of capital of levered and unlevered firm will be equal to the opportunity cost of capital. Next, here we are going to discuss the MM approach with the taxes, the trade-off theory of leverage. The MM Modigliani and Miller approach assumes that there are no taxes, but in the real world this is far from the truth. It's not a practical condition. That's why this theory recognizes the tax benefits accrued by interest payments. The interest paid on borrowed funds is tax deductible. However, the same is not the case with dividends paid on equity. In other words, the actual cost of debt is less than the nominal cost of debt. The trade-off theory advocates that a company can capitalize its requirements with debts as long as the cost of distress, that is, the cost of bankruptcy, exceeds the value of the tax benefits. Thus, the increased debt unit, a given threshold value, will add value to a company The approach with corporate taxes does knowledge tax savings and thus offers that a change in the debt equity ratio has an effect on the overall cost of capital. This means that the higher the debt, the lower the overall cost of capital. The Modigliani and Miller approach is one of the modern approach of capital structure theory. Here, with this model, we can know the arbitrage process. The investors can avail the arbitrage process of the by investing in securities. Here, the arbitrage process is the basic premise is that proportion 1, the total value of firm will be constant irrespective of the degree of leverage. Similarly, the overall cost of capital of the firm and market price of shares remain constant irrespective of the debt equity mix. The justification given by hypothesis is the arbitrage process, the act of buying an asset or security in one market at lower prices and selling in another market at higher prices. This process results in eliminating the price differentials and reaching the equilibrium stage. Arbitrage process is a balancing operation and is based on the law of one price. The approach relates the arbitrage process with reference to valuation of two different firms which are identical in all respects except leverage. One firm is leveraged and other is unleveraged. Investors of the firm whose value is higher will sell their shares and buy shares of the firm whose value is lower. They can earn the same return at a lower outlay with the same or lower perceived risk. It will be beneficial to them. Such an act of investors lead to increase the share prices or value of the firm whose shares are purchased or unlevered, lowering the prices or value of shares of the firm whose shares are sold or levered. This value continues till the prices of the homogeneous firm becomes identical. Thus, the switching over process arbitrage, that is called arbitrage, brings the share prices of homogeneous firm together is called equilibrium price. The arbitrage process helps the investors to earn the same earnings by investing less in unlevered firm whose value is less. Thus, corporate leverage is substituted by homemade leverage or individual leverage. Here, criticisms also are there for the approach of arbitrage, approach of the capital structure theories. Here, without taxes, the criticisms are there. First criticism, it is not possible to borrow funds on the same terms and conditions as corporate can. Next criticism, personal leverage is not substitute for corporate leverage. Next one, existence of transaction cost. Automatically, there is a transaction cost. Without transaction cost, there is no the economy. Next criticism, institutional restrictions. There is so many restrictions are there for the institutions. Last drawback, asymmetric information, existence of corporate tax. All investors cannot know the same type of information. Some investors know the information, less information they know, and some investors they know more information. Here multiple choice questions are there. Thank you.